conditions. The basis of all our terms and conditions are the statutory requirement, like NIH salary cap, that's a statutory requirement, and federal terms and conditions. Then the next step is our sponsored terms and conditions. So we apply uniform guidance to all NIH grants, but NIH also has their grant policy statements and their own terms and conditions. And then we apply our institutional policies. We generally, since we are a state institution, our policies are very much designed after federal policies. So they're very similar, but we also have to remember to apply our institutional policies. And then award specific terms and conditions. And we know by UG and by NIH, terms and conditions, they allow purchasing equipment on sponsored programs. But the particular award that we are dealing with, let's say it's a training grant supporting a postdoc, the award does not allow purchase of equipment. So the award terms and conditions will apply to that sponsored program. So this is the basis how we actually look at the terms and conditions and then, decide on what is allowable versus unallowable. Now, we continuously hear, hey, it's a federal contract and, FAR applies. What is FAR? So FAR is nothing but federal acquisition regulations. So the government is trying to purchase something. These are their procurement policies. And these are codified under Title 48 of the CFR. So we do have another session on contracts, and I'm sure, FAR will be discussed more during that session, but I just picked out a few notes about the FAR that, basically impacts us, the financial side. So let's quickly go through this. What is the purpose of FAR? FAR is to make sure that the federal government across the board, they are doing their, cost price analysis. They're looking at the quality, looking at efficiency of, the contractor's performance. And then they are establishing uniform acquisition procedures. So this is what we have in our purchasing policies. So this is kind of purchasing policies for the federal government. And so, and also there is one particular FAR that actually incorporates the uniform guidance for federal contracts. So this is the FAR clause that, we should have ideally on all our federal contracts. This is FAR 52.216-7, Alt 2. Once we have this clause within our contracts, then we know that we can say, hey, we have to follow the uniform guidance, 2 CFR 200. So generally, when we are negotiating with a federal contractor, their selection of FAR clauses will default to commercial cost principles, part 31.2. So we have to make sure that we change it to 31.3, and then automatically all these clauses will be available for us to select from all the list of FAR clauses. So this is just to remind us that there is a way we can incorporate the uniform guidance within a federal contract. Now, this is another FAR clause that we expect to see in a federal contract. This is basically providing the cost limitation for a fully funded cost reimbursable contract. So what it allows us to do is to notify the government before we reach a specific dollar threshold. And then we let the government know that, hey, we need more money from you. And we open up the pathway to renegotiate the contract terms, submit a supplemental proposal asking for more money. So basically, we go with a 60-day notification period when we reach 75% of the contract amount. So basically, we are saying, hey, we are under budgeted. Sorry, we made a mistake. We want to submit a supplemental proposal because we sent you a limitation of cost letter 60 days ago. And based on that, we should be, allowed to submit a supplemental proposal. And again, remember, this is on cost reimbursable contract. The other term that we like to have in our contract is the limitation of funds. Now, this is when the contract is incrementally funded. And this is when we notify the government 60 days before we reach 75% threshold that we are running out of funding. You better release the next increment quickly. So this is a little different from the previous clause, because here we are still staying within our budget, but we are running out of money. So you better release the next increment so that we can start spending and we can invoice you to get the payments back. Now, again, if you all have any questions, feel free to send it through the chat or, stop me and ask me questions. I don't mind at all. Now, these are, a quick recap of some of the contract types and their purposes. So the contracts that generally come to the universities are, research and development types of contracts, and sometimes services. We will not get a federal contract to provide them with supplies or do a construction for them. So the contract types are generally fixed price, cost reimbursable, time and material, and cost plus fee types of contracts. For a fixed price contract is higher risk. We have already negotiated a contract price, and if we go over that, we are not going to get any more money, yet we have to, stick to the deliverable promises that we have made with the agency. Fixed price contracts, they have more flexibility with budgets, and limited financial reporting and invoicing are required for fixed price contracts. Cost reimbursement contracts, the budgets that are submitted for a cost reimbursable contract are, generally on best efforts basis. So there are situations when we can run out of money, and we do have the option to go and ask for more money. So that's why you will see that majority of our federal contracts are cost reimbursable contracts. But cost reimbursable contracts require more frequent financial or cost projection reporting from the PI side, not from the central OSP offices, and they have tighter budget controls. Then the time and material contracts, these should never come to the universities. We should never accept time and material types of contracts, because we do not pay people, everybody, on an hourly basis. We do have exempt and non-exempt staff. So the non-exempt hourly employees, are receiving pay based on hours worked, but the exempt staff cost plus fixed fee, rare to most universities, but I worked for University of Southern California, where we had a contract where it was based on cost plus fixed fee. We were getting 5% fee from the federal government, and it was an UARC, University Affiliated Research Center. And then I also worked at Caltech, where JPL is another cost plus fixed fee kind of contract, where Caltech receives a portion of the cost to manage the award, plus their administrative costs for managing the JPL NASA contract. So these fees can be either fixed, incremental, or based on performance. Generally, I have seen fixed fees for both the universities I worked at. So now, let me ask you this question. A procurement contract is used for which purpose? Transferring money to a recipient, training projects, providing services, or acquisition of property or services? Can somebody, give me an answer? Just tell me which is the right answer.
B?
No, it's actually, let's see. It's actually D. So what happens when a federal government issues us a contract? Generally, they're getting some property. Okay, property doesn't mean that it is a tangible property. It can be an intangible property also, or services from us. So that's why the answer is D. You will know why, it is D, because you will see the definition of property during the presentation. So now these are the guidelines, federal guidelines that apply to federal agencies that are issuing grants and cooperative agreements to non-federal agencies. So when the federal agencies are issuing these grants and cooperative agreements, these awards to us, they ask us to follow these federal guidelines, plus their own terms and conditions. So these guidelines are codified in Title II, Subtitle A, Chapter 2, and Part 200. So when we say 2 CFR 200, that's where these are prescribed within the Code of Federal Regulations. So Title II means, and believe me, this is straight from the website, from the Uniform Guidance website. So you have access to the same data as I'm sharing with you. So Title II is, especially, they especially apply to grants and agreements. Subtitle A is issued by Office of Management and Budget. That's why, they have to distinguish this. Under the right subtitle, Chapter 2 is also Office of Management Guidance. Part 200 is Uniform Administrative Requirements, Cost Principles, and Audit Requirements for Federal Awards. This is the actual name of 2 CFR 200/Uniform Guidance. So these guidances, they govern grants and cooperative agreements, and terms can be referenced in other award mechanisms and not just federal sponsors. So, sometimes we see that a salary cap applies to, a non-federal sponsored award, mostly foundations. But the salary cap should follow, NIH guidelines, statutory guidelines. So that is an example of how a non-federal sponsor may reference to federal guidelines or federal statutory requirement. Now, the uniform guidance was created out of 8 different OMB circulars, and these are the different OMB circulars that got incorporated into one single circular. So number 2 is A110. Number 3 is A21. These are the ones that used to apply to us, to the universities. A133, and number 8, A50, which, besides the central financial areas and the internal audit group, not many of us will see this, number 8 circular. But now all these 8 circulars are incorporated into the uniform guidance. So the uniform guidance, UG, has 6 parts, subparts. Subpart A is for really the acronyms used throughout the guidance and their definitions. Subpart, the definition of terms, not the acronyms, the definition of different terms. And I have used some of those definitions during my presentation. Subpart B is the general provisions that apply mainly to the sponsors. C is the pre-award requirements. Now, D, E, and F are related to post-award. So subpart D is the post-federal award requirement. Subpart E defines the costs and cost principles. Subpart F is related to audit requirement. Now, besides this, we do have federal agency-specific grants and conditions. They are mostly designed after the uniform guidance, but they do have, I just gave, 3 examples. For National Science Foundation, we often reference the PPG, Proposal and Award Policies and Procedures Guide. NIH, we call NIH policies and procedures related to grants are, in GPS section this says blah, blah, blah. So that's what, GPS, we often refer. They also have their own general terms and conditions. And I have just provided some links to the agency-specific terms and conditions. Now, this is where we start talking about the uniform guidance and subpart D. So subpart D is under 2 CFR 200.300 series. So they have standards for financial and program management section. They have a section for property standards, section for procurement standards, performance and financial monitoring and reporting standards, subrecipient monitoring and management standards, record retention requirements, remedies for non-compliance, closeout, post-closeout, and collection of amounts due. These are the sections under subpart D. So I picked out a few important, standards under each section, and I talk a little bit about it. But if you get a chance, please go in and look at subpart D if you are in, post-award management. Again, post-award does not mean only financial and technical management of sponsored programs. So let's start with standards for financial and program management. They're all under 200.300 to 200.309 sections. So basically, what these guidelines, when they talk about financial, procurement, properties, sub-award management, these standards, they just require us to have internal controls, to have a proper system in place, to have written procedures. So you will see the same requirement across the board. So when we're talking about financial and program management, obviously they need us to have a sound financial system in place that will follow the record retention policy, that will identify the funds separately, and also we will be able to track the statutory and policy requirements or the restrictions through the financial system. Again, NIH salary cap is a great example. Cost sharing is another example. And then we should also be able to measure performance, not only through the financial system, but there has to be a combination of systems through which we should be able to measure performance. So you have your budget set up, you have your expenses against the budget. By looking at the expenses and the budget combination, you do have an idea of where you're going, if the award is heading to the right direction. So those are the requirements that are stated in these standards. So again, I am trying to separate out the post-award requirements into two categories, non-financial and financial. And this is, my theory. You may not agree with me, but this is how I look at it. So in the non-financial post-award administration, you have to, be very careful of setting up the period of performance, prior approval requirements for budget and program plans. You have to have your property standards, procurement standards, your performance reporting, record retention and access, and closeout. So these are requirements, and a lot of these will need to be handled. If you imagine our Office of Sponsored Programs, a lot of these need to be handled from OSP pre-award side, or our fixed asset folks, or our procurement folks, and the PI. On the financial administration side, we have to have internal controls placed everywhere over all our processes. And I would say a financial unit like, us or internal audit should oversee the internal controls. Our payments, when we receive payments from the sponsors that are under financial administration, and us invoicing the sponsor, cost sharing or matching, are we tracking it properly? Program income, are we tracking program income correctly? Subrecipient post-award monitoring, what's happening with the subrecipients' invoices? Are they all reviewed and approved by the PI? Financial reporting, financial termination. Now, termination should go to both sides. Financial termination is what under financial administration. And closeout, financial closeout. Did we close out the PO? Did we move the GRA to a new award? And is OSP post-award submitting the final financial report on time, the final invoice on time? Those are all under financial administration. So now, I just pulled out some of these sections, and I already talked about this. Financial management system is separately discussed under 200.302. And they state very clearly that we need to have a financial system that gives the complete financial information of a federal award. We have to have effective control over all funds. we have to be able to identify property and other assets quickly through the financial system. And we are also going to be able to compare expenses against budgets. So we have to have written procedures to implement the requirements of payment and how we determine the allowability of costs. And I think, if you all have seen our financial system, we are fully adhering to all these requirements, okay? So generally all the universities are designing their financial systems following these requirements. Now, this is where you will see internal control is mentioned all across the uniform guidance. We have to now, in the uniform guidance, they have provided 2 different ways of establishing internal control. And set up internal control structure framework following COSO principles. So we have created, in PostAward, we have created our internal control framework following the COSO structure with the help of internal audit. We created our own, and then we went and took it to internal audit and got it reviewed and approved by them. So all our practices, our policies, procedures are falling within this framework. And, we are required to review the framework every year and make sure that we are, updating the policies and procedures as required. But we do have it at UVA. Comply with and evaluate compliance with federal statutes. So this is where, we statutes, regulations, and terms and conditions. So these are my examples of, again, NIH salary cap, regulations. We have lots of regulations throughout the UG that we follow, and we will talk about that. And take prompt actions for non-compliance. You know how all of us are so careful about any non-compliance with the federal awards. All of us are. Not only federal, sponsored awards. So we are very aware of, this action. We do like to take prompt action. We do like to move expenses out. We do like to, fix our procedures, our practices, so that it doesn't happen again. So then, I just added this point. UG makes repeated references to internal controls across all facets of sponsored project administration. It's not only financial, it's procurement, payroll, cost transfers, IRB, ICOOC, hazard preventions, biosafety, clinical trials, everything, everywhere. They talk about having proper internal controls put in place. For now, this is where, subpart D talks about the payment. Now, for since we are not a state agency per se, we are state-funded Institute for Higher Education. We fall in the university IHE group, but for states, the payments come directly from the government through their CMIA agreements. For us, we have to submit invoices to the federal government requesting for either advance funding or reimbursements. We do not like to ask the government for advance funding, because if we receive advance funding, then we have to keep it in an interest-bearing account, and we have to issue interest payments to the federal government. So some DoD agencies used to give us advance payments, but now it's all stopped because we do not want to, go through that additional administrative burden. So the government actually says that government agencies should pay us within the 30 calendar days. And if we are passing through government money, then we should also use the 30 calendar day turnaround time for paying our sub-awardees. Now, this is where we just talked a little bit about, the kind of invoices or reimbursement requests that we submit against grants and cooperative agreements. So for grants and cooperative agreements, since we submit a single line reimbursement request using a standard form, a government form, SF-270, what the government wants us to do is submit financial reports periodically. So for NIH program projects, we have to submit a financial report every year. For NIH regular R01 modular grant, we submit a financial report at the end of the project period. For Department of Defense grants, we submit a single final financial report. But we get reimbursed through an SF-271 line reimbursement request. Now, agencies like NIH, NSF, NASA, Department of Energy, USDA, they all allow us to go into their payment management systems and ask for the reimbursement, and they pay us within 2 days. So that is the letter of credit arrangement with the federal government. If we have a good reputation with the audit community and our single audits, our A133 audit reports are all good, we get these flexibility of going into the government site and drawing the money down based on our actual reimbursements, what we have already spent. But if I am a school that has lots of audit findings and single audit report says we are a high-risk entity, then we do not get this kind of flexibility, okay? So this is something that we have to keep in mind, that the government is allowing a lot of flexibility if you are lower risk auditee. So foundations generally pay in advance, and we have to keep that advance money invested with short-term investment, ideally short-term, and the interest earned on that investment is actually added to the research budget. Now, we do have sometimes we get to keep the interest earned, and if the research project is ended, we can actually move it to the PI's account. Now, are there any questions, Rita? Because I'm not going out of this presentation to see the chat. Okay, so it's almost 11 o'clock. Do you think that you need a break? Okay, thank you, Mary Beth. Yeah, Clara says the same thing. So these are the payment methods, and and I just explained why we have to submit financial reports. Now, just because we get that special arrangement from the federal government to go and draw money directly from the agency's payment management systems, we are required to submit a federal cash transaction report, which is just showing them our cash standing every quarter. And that is done by PostAward, by the central office. NSF does not require us to submit the FCTRs. NIH is also going to stop requiring us from submitting the quarterly FCTRs very soon. So that's another, cash report that we have to submit from the central unit to the government. Now, contract payments, however, are based on public voucher or standard form 1034. Sometimes the federal agencies ask us to use a 1035, standard form 1035, which is very similar to 1034. But in that invoice, we have to provide expense details at the expenditure category level. So we have to say salaries, benefits, equipment, travel. So all those spell out all the different categories. It's not like, just a single line asking for reimbursement as the SF 270 on a grant or a cooperative agreement. Now, we do also have milestone payment schedules where we have to track it between the central area, PostAward, and the PI departments area. We have to coordinate and make sure that the milestone deliverable was achieved, and then we send the invoice. Clinical trial payments generally come from the CRCs who are uploading the patient visit information to the sponsors, to the industry or pharmaceutical company side, and then payments are generated. So for clinical trials, we do not have the invoices entered into Oracle. We acknowledge the payment and create an invoice after the payment is received. But for all other invoicing, we create an account receivable account within Oracle system associated with the award. So once the payment comes, we apply the cash against that open receivable, zero it out. So that's how it works in our world. Now, again, this is a quick chart of award type and invoicing and financial reporting requirement. So for federal contracts, we invoice using SF 1034, standard form 1034, detailed invoicing. Financial report is not submitted from the central area, but the PI may have a CDRL, that is a contract data reporting listing. So where they have to use it, they have to submit a cost projection report from the PI side. Non-federal contracts, if we have to submit a detailed invoice, we try to requirements from the SF 1034, but use a very similar template to invoice the non-federal sponsors for contracts. And financial reporting, again, from our side, there aren't any, but we don't know what the PI and the departments, they have to sometimes, produce financial reports to the non-federal contracts also. Federal grants and cooperative agreements, they are standard reimbursement request, single line request submitted through SF 270. Financial report is also a standard form, federally mandated form, SF 425. For non-federal grants, we try to send them the SF 270 kind of invoicing, just as single line invoice. Sometimes they don't buy it. Sometimes they pay us in advance. We don't even have to invoice them. And financial reports for non-federal sponsors, they are pretty extensive. So now this is the part cost sharing or matching. And since I've come to UVA, I have talked about cost sharing multiple times. And we now have a cost sharing policy designed after the federal guidelines and a practice compliant with federal requirements. So what is cost sharing? See how I am referencing 200.29, that is from Section A definitions. So cost sharing or matching means the portion of project costs not paid by federal funds, unless otherwise authorized by federal statute. So simply stated, cost sharing represents sponsored project costs, direct and F&A, that would normally be borne by the sponsor, but instead are covered by the institution or a third party like a subcontractor or a consultant. So these are the university resources. I also like to call them university investments towards research. Now, there are different types of cost sharing. The first type is mandatory. It is required by the sponsor. Second type is voluntary committed. It is not required by the sponsor, but our PIs offer, PI or institution, we offer to share part of the cost. Voluntary uncommitted is institution generally supports a lot of research costs, and they are not committed in the proposals and they do not need to be tracked. So mandatory, I have another slide, that's why I don't want to talk a whole lot. So the three types of cost sharing. Mandatory is required by the sponsor and it is stated in the solicitation. And it is a program condition, an award condition. So let's say, Department of Energy, notorious for mandatory cost sharing. They will say, this program, requires 25% cost sharing. They are quantified in our proposal. They're legally binding. We have to report mandatory cost sharing to sponsors. And that cost shared expenses, they get included in our modified total direct cost base when we calculate the F&A cost rate. I'm going to leave this for now. I'm going to talk about this when we talk about how F&A rate is calculated. Voluntary committed cost sharing is not required by the sponsors, not included in the solicitation, but we include a quantifiable amount in the proposal budget. When that proposal is awarded, it becomes legally binding. We have to report on that to the sponsor. We have to include cost shared expenses in our F&A rate calculation. Voluntary uncommitted cost sharing is not required by the sponsor. We do not quantify in the proposal. Not legally binding, and we do not have to report to the sponsors, not included in the F&A rate calculation. So we can actually tell the PIs that instead of quantifying institutional support in the proposal budget, let's go and use the other support area in a typical SF424 form in the proposal, and say, instead of saying from School of Engineering, PI so-and-so will spend 25% of his time in the budget, we make it voluntary uncommitted by stating in the proposal, PI so-and-so from School of Engineering is available for advice. Not say 25% of his time. instead of saying core lab support in the form of $100,000 is available for this proposal, we go to voluntary uncommitted cost sharing and we say core lab support is available for this work. So we do not quantify, and that's how we make it voluntary uncommitted cost sharing. So this is the difference between mandatory, voluntary, and voluntary committed and voluntary uncommitted cost sharing. When we offer voluntary committed cost sharing, we have to track it exactly the same way as mandatory cost sharing. When it's awarded, it becomes mandatory. So we have to set up companion accounts and we have to track them, we have to report on them, and then cost analysis group, when they are working on our next F&A rate, they have to include all those costs in their research base. So for federal guidelines in the UG, the government came out and said, hey, let's not include cost sharing as a factor to determine the merit of an award. So it was, what was happening was, you know, the rich schools would go in and say, hey, we can come up with $100,000 of cost sharing if we get this award. So the peer reviewers, the proposal peer reviewers would look at that and say, oh, so this is, you know, this school has the money, so we should award this proposal to this school. So the government actually now has, you know, decided that we are not going to use cost sharing as a factor during the merit review process unless it is a part of the proposal solicitation. So this is, you know, clearly stated in Appendix 1 of the UG. Now, when cost sharing is included in the solicitation as a program requirement or becomes, you know, mandatory, voluntary committed cost sharing becomes mandatory, they should be easily verifiable from the financial records. We are doing that through companion accounts, not included as contributions for another award. If we are booking our costs in the companion account, they're not included as contribution for another award. They're necessary and reasonable. We are applying the same cost principles and they're not paid for by another federal award. We know that it's institutionally funded. Unrecovered indirect costs need to have prior approval to be used as cost sharing. And these are really, you know, true costs of research. So we should be able to submit our cost share budget, including the indirect costs that we are not recovering because of institutional funding. So only allowable costs can be cost shared. They are generally faculty salaries, benefits, and these are all the cost categories that you can see that we can cost share. Sometimes, you know, we get confirmation that third parties will also cost share. Sub-awardee cost sharing is really, you know, we see this more often. So if we have cost sharing requirements and we have a sub-award given to another entity, we also, you know, require the sub-awardee to cost share. Sometimes, you know, donated property is cost shared and we need to have the value of the donation. I'm sorry, this is little, you know, I don't know if you can see it. We have to document the value of the donation and put a dollar amount against that donation. Unfunded collaborators, consultants, cost sharing, and again, we have to quantify their amounts based on their actual rates that they're not taking from us. So those are, you know, the third-party cost sharing documentation that we need to have. Now, this is a question, if, you know, somebody can tell me, cost sharing can be best described as waiver of indirect cost, federal funds remaining from a previous project, supplemental salary for a principal investigator, or contribution by awardee to the total cost of the project, which is the correct answer? Everybody said D. Good. So contribution by awardee to the total cost of the project. So what is the effect of cost share on the F&A rate? Increases it, decreases it, no effect, cost share is not figured in the indirect rate. These are the 4 options. Who can tell me? So a lot of you said B, which is the right answer. Excessive cost sharing decreases our F&A rate, and I will share it with you when we talk about the F&A rate. So it decreases our F&A rate. Okay, program income. So program income is, again, I took the definition directly from the uniform guidance. It includes income generated by the sponsored program. I have seen that PIs, buy supplies and modify the supplies to create widgets, and then the PIs actually sell some of the widgets to a collaborator who also needs those widgets. And when we receive the money from the collaborator, we book that as program income. If we are receiving program income, we have to track the income against these sponsored awards, and generally the program income gets added to the research budget. So what happens is we give the money, we apply the money to defray the costs of the federal share, and then PI gets more budget than the original awarded budget, so add it to the budget also. But the thumb rule is, if we have received program income, we should apply that to reduce our billing to the government. So that is the rule of thumb, and which we have to do. And it is done by us, by PostAward, when we are submitting our letter of credit draws to the government. Now, we can use program income to fund cost sharing, but we do need prior approval, sponsor approval for that. Now, which of the following is considered program income? Petty cash reimbursements, tuition from training programs, rental or usage fees from equipment purchase with grant funds, reimbursement for medical services for principal investigators' expenses. Right, C, very good. Now, this is a period of performance, which we already know. I'm, going a little fast with my presentation because I haven't even come to the cost principles. I take too long, to do these presentations. So we already know what is the period of performance. We should have all the expenses also booked during the period of performance, unless we get special approval from the sponsors to either pre-period of performance spending, or no cost extension spending by extending the period of performance. So now this is an exception to the rule, and this is from the cost principle side. See, it's 200.461. 400 series is part E. For publication and printing costs, sometimes the non-federal entity may charge the federal award before closeout. So this is when we have already, submitted all our interim reports, but we may have some expenses for publication costs that can be charged, but before we close out the award. So we will, I don't think we have come across any situation like this yet, but if we do, we will have to figure out a way to post that charge to the PATEO and then, draw the money from the government, from the sponsor, but before we close out the award. So this is revision of budget and program plans. These are the conditions for which prior approvals from the sponsoring agencies are required. If there's a change in scope, change in key person that's specified in the budget, disengagement of a key person for more than 3 months from a project, or a 25% reduction in time devoted to the project. So these are the conditions where we have to go back to the sponsor and ask for pre-approval. Charging some unallowable costs, transfer of funds from participant support costs. Participant support cost category is a restricted cost category. So if I have leftover budget in the participant support cost, I cannot use it for research without consulting, without sponsor approval. And any other, changes in the cost sharing. If we need more money to complete the project, these are the times when we have to go and get pre-approval. Now, if we want to do a 90-day pre-award cost, some federal agencies have received permission from OMB to let the institutions incur 90 days pre-award costs and give ourselves a 12-month no-cost extension. That's NIH. NIH does that through their expanded authorities. NSF allows us to do that. DOD, they allow us to do this. So all these are, the agencies, the federal agencies individually had to go to OMB and ask for approval, and now they're passing those down to us. Federal Demonstration Partnership, FDP, we just wanted to mention the FDP, partnership collaboration. So basically, we formed a cooperative initiative between the federal agencies. So right now there are 10 agencies that are members of the FDP, and there are, I don't know how many schools and nonprofit organizations. Right now there are, so I said 450, maybe more. So basically what we did was we sat down with the federal agencies and said, hey, we are going to standardize some terms and conditions and call them research terms and conditions. That way, that all across the university world, we are applying these research terms and conditions, and, the federal agencies, they accept those terms and conditions, and they allow us certain flexibility. They say that prior approval, or you may need prior approval. So this is just a snapshot of part of the prior approval matrix that is under the research terms and conditions. It is great to go in and see that for changes of PI, all the agencies need prior approval. For use of unrecovered indirect cost, including indirect costs on cost sharing and matching, some agencies have waived the requirement to go in and ask for prior approval. So this prior approval matrix is really helpful. Then, the subpart D has property standards. So you have to have a proper property system, fixed asset system that tracks the federally funded, federally owned, and institutional owned property. So I have given definitions of real property, which means land improvement, structures, and personal property. Personal property can be tangible or intangible property. And then there is also federally owned property, means, property acquired under a federal award. So, and agency gives us the title of the property. So we have to give an annual inventory listing, and we have to, make sure that it's maintained within our property system. So now equipment is a tangible personal property. Okay, so we generally get the title of the equipment, and we are not allowed to earn program income via usage fees from federally awarded equipment. And then we know that we have to maintain property records, and every 2 years we have to go in and do a physical inventory of the property. This is required, and our fixed assets group actually does this. Now there are standards for supplies that are acquired under federal award that are more than $5,000 in total value. So this is also under the property standards. And then intangible property is property having no physical existence. This is like, trademarks, copyrights, patents. And under 200.315, you can see all the standards that apply to intangible property. Then we have procurement standards between 200.317 to 326, where again we are supposed to have proper procurement system in place, procedures. We have to maintain standards covering conflicts of interest of employees engaged in selection, award, and administration of contacts without real or apparent conflict of interest. So this is also very important. And we know, I think all of us, we have to certify our COIs every year or every 2 years. I don't know if it's changing now. So, so these are the procurement standards. Procurement standards also provide guidelines for methods of procurement. Now, micro purchases have been increased $10,000 as of, I think, August 17th. So for micro purchases, for supplies and services, we do not need to have competitive quotes and any kind of cost price analysis. Small purchases, they are more than micro purchases and less than simplified acquisition threshold, that is 250K. We do need to have simple and informal procurement methods for services, supplies, where price or rate quotations must be obtained from an adequate number of qualified source. See, they did not explain what is an adequate number. I can say 2, or some other university saying 3. So these are the methods of procurement that are included under the procurement standards. Procurement standards also have requirements for contracting with small and minority businesses using those vendors. And then, we have to do the cost price analysis. This is, something that we added: equipment definition versus supplies versus fabrications. So fabrications can include supplies, but once it's placed in service, it gets capitalized and everything, is exempt under the MTDC base. It's considered a piece of fabricated equipment. So we just wanted to mention that over here. And then, these are just some standards that we have to follow. We cannot purchase unnecessary items. We have to see what kind of, let's say, supplies. PI wants to buy, very special cables. We already have those in stock. Why don't you use, the leftover supplies? Then this is the financial reporting piece of it. We are using standard forms, standard financial report SF425, also called FFR. Then this is where we have to, explain how we are supposed to monitor and report on program performance, reporting on real property, which is required at least annually. And then we come to the subrecipient monitoring section. So the UG clearly defines what is a subrecipient or a subawardee versus a contractor. A subawardee is when a subawardee gets involved with the actual scope of work, and they can make programmatic decisions, and they will generally carry out the program for the public purpose of the grant, whereas a contractor will provide goods and services within their own normal business operations, and they operate under a competitive environment, and is a vendor contract is not subject to compliance requirements of the federal program. So vendor contract will say, hey, you're purchasing this Dell computer for $4,000. We buy it under a purchase order, and that's it. Whether they are going to spend that $4,000 following any kind of federal cost principles doesn't matter. However, if it's a subaward, the subrecipient has to follow the cost principles and federal guidelines that apply to the main award. So pass-through entity is when prime awardee. Now, this is where the UG explains what kind of subaward or subrecipient monitoring is required. And this is also, again, something that we need to follow, and we generally follow, because when the subawards are issued, we flow down all the federal guidelines that apply to us to the subawardee. We in fact give them a specific period of performance budget. We flow down our CFDA number. We tell them, if you're NIH, if we are NIH grant, you have to follow NIH salary requirements. And then we also complete a risk assessment of the subrecipient before the subaward is issued. We have to do that. Then we have the record retention and access to records policy under the UG in sections 200-333 to 337. So we are supposed to retain records for 3 years from the time we submitted our final financial report, but we retain the records for 5 years. And if there is any litigation claim or audit, then that record retention policy does not apply. We have to start a new record retention policy from the time the litigation claim or audit is resolved. Then remedies for non-compliance. What happens when we are not in compliance? We can lose all the flexibility, the letter of credit arrangement with the federal government. We can, the government can disallow the costs, either direct or indirect costs. They can early terminate an award. They can say it's a systemic issue, and we are not going to give you any awards for the next 3 years. So there are a lot of, bad impact from non-compliance. And then not only the federal government, even if we are receiving pass-through money as a subawardee from another institution, they apply the same restrictions as the federal government to us getting the awards. So these are the closeout adjustments when, we have to clear up all our obligations and submit our financial reports and performance reports within 90 days. Now that 90 days have been extended to 120 days, according to the updated UG, which will go into effect sometime in November. So we are getting a few more days over here for submitting our final reports. And then we have to refund any unobligated cash, refunds or rebates promptly. Cannot hold on to money that belongs to the federal government. So, so from our perspective, we kind of work with the departments. We notify them 90 days before an award ends, and then again, 60 or 65 days after an award ends, and then we finalize the numbers and we report to the agency. And now this is part E, cost principles. So from 200.400 to 200.475 is all about costs. So a typical research project includes direct costs and indirect costs, okay? Direct costs are costs that can be identified specifically with the project. Indirect costs are facilities and administrative costs are costs incurred for joint purposes. And, but those are true research costs. So the F&A costs are allocated to all research projects through a cost allocation methodology, which is called indirect cost rate proposal that we submit to the federal agency that is assigned to review our indirect cost rate proposal. And then they review and approve it, and then we apply the indirect costs or F&A costs through that allocation methodology. So the Federal Cognizant Audit Agency for indirect costs is DHHS for UVA. What is the F&A cost rate? So F&A cost, again, this is directly from the definition 200.56, means the cost incurred for a common or joint purpose. But these are true costs for research. So a single number or ratio is used to reimburse the university for the use of university buildings, university equipment, interest on debt of billings, operations and maintenance costs, general administration, departmental administration, sponsored projects administration, library costs. These are all included in that F&A cost rate. So this is how we show the blue letters are F costs. They belong to the F cost pool, and the A component are in the A cost pool. So F&A cost pools divided by direct cost. So direct costs are modified total direct costs, okay? So you can see subcontracts up to 25,000 is included in the direct cost base. Committed cost sharing is included in the direct cost base. Salaries, consultant services, travel, these are all in the direct cost base. So this is how the F&A cost rate is calculated. Now, let's say that this was the total F&A cost, and these are actual numbers for UVA. I don't know, goes back to 3 or 4 years ago. So this is the F&A cost pool, and it is divided by MTDC research base. And that's how we came up with 61% of F&A cost rate. Now, if we are cost sharing, this base gets increased. When the base is increased, your rate goes down. So that is the simple principle of over cost sharing. So we are not operational cost through F&A cost rate. That's why the universities do not like to cost share unnecessarily. So remember this, and every time you see your PI offering to cost share, find out what is the merit of that cost sharing. Why are we cost sharing unnecessarily? Now, yes, there are times when it will benefit the institution if we cost share, but then make sure that you include waived F&A in that cost share amount, because that will show the agency how much we could not recover. So now these are the types of F&A rates. There is a lump sum F&A rate. We use the predetermined rates normally for 2 to 4 years. And this is where you can actually see all the different types of F&A rates. Now,
can I ask you a question?
Sure.
I put this on the chat too. Can you explain why would a PI want to volunteer cost sharing when it's not mandatory? What's the advantage to them? Why would they want to do that?
So if it's very prestigious research work, and the PI is absolutely convinced that if we get funding from the federal government, the results are going to be, great, and it's going to benefit, the public in general, benefit the university, then the PI offers cost sharing. And
does the PI think that they're going to get the grant or the contract if they volunteer to cost share?
Right. So
okay.
The question is that the award will come to the university. And remember, when the PIs are offering cost sharing, they're also getting approval from their department chair or dean's office, and then the cost sharing is submitted. So I used to work at a university, private university, where voluntary cost sharing, if a PI actually offered voluntary cost sharing, the PI had to come up with the lost F&A, their own non-sponsored account.
Thank you.
You're welcome. So these are the reasons for cost principles. They set uniform standards for costs. We require the cost to be allowable, allocable, reasonable, necessary, and consistently applied. So the allowable piece of it is included in the cost principle section of the UG. Allocable costs are also, talked about largely through F&A rate, and also, how you can actually see if you can distribute the costs based on proportional benefits received by the projects. Reasonable are addressed through the procurement standards. Necessary, again, is very similar to allocable. Consistent is where, we say that if Urmila's salary is administrative salary, we should always treat Urmila's salary as administrative salary. We cannot say, oh, Urmila is now, getting salary for research. So, and Urmila's salary cannot be directly charged to a research project because it's recovered through F&A rate. So that's the consistency. Oh my goodness, what did I do? Sorry. I wanted to see the chat and then I went, about 15 minutes. Okay, so I have to go real quick through these. So now we have unallowable costs also mentioned through this section of the cost principle. So Now, allowable costs, questionable costs are, of course, food, foreign travel. If it's not allowed by the sponsor, that's, that may be an unallowable cost. Honorarium payments. If it's a speaker fee payments that over here we use the expenditure type honoraria, then we do need to have a conference that is hosted by us or a meeting where the speaker is coming and talking. So that's how we actually check allowability and allocability of honorarium cost. And consistency is either cost should be always direct and always indirect, or with sponsor approval, an indirect cost may be charged to a direct cost category. Again, we need sponsor approval for that. Reasonable, we do the cost price analysis. We make sure that we always go for the best value for the cost for a federal government. So that's the reasonable cost. Now, this is the compensation area. So compensation is a very big deal because compensation costs, our salaries and benefits are like probably 80% of our research costs. So we do have some rules, some definitions, very clear definitions of what is allowable by an institution for higher education to be charged as compensation to a federal award versus allowable activity versus incidental activities. And then it goes on to define institutional based salary, the annual compensation that is paid by an institution for individuals' appointment. So this is where, I would recommend that you go in and check what are our policies for IBS, institutional based salary. I'm talking about, cost sharing IBS because all these things happened, all these policies happened after I came to UVA because I was surprised that, there were no policies related to all these compliance, high risk compliance areas. Now, what we have to do is we have to have effort reports or payroll confirmation, standards for documentation of compensation. How did we pay? Why did we charge a specific percentage of somebody's salary to a federal award? Did the federal award receive the benefit of that salary charge? That's exactly what we are trying to prove through the documentation process. Now, there are other special categories of costs which are, again, very restrictive. Participant support costs is only allowed when it's included in the authorized budget, and also or we go and get approval from the sponsor, and we cannot rebudget between any. Are paid from AP, from accounts payable. But if it's a training grant, of course, you're going to pay stipends to your fellows. So it is allowed, stipends are allowed on training grants versus research grants. I just talked about honorarium payments, foreign travel. We actually check at OSP Post Award if the foreign travel followed the Fly America Act and the subsequent, the allowable treaties between the foreign government airlines and US. We have to see recruiting costs, alterations and renovations. These are all restricted cost categories. Now, which are the following costs allowable according to the uniform guidance? Bad debt is unallowable, entertainment unallowable, losses unallowable, payments to subjects is allowable. Now, these are the cost accounting standards that we have to maintain, and we need a disclosure statement to be submitted to our federal cognizant agency who is responsible for approving our indirect cost rates. The disclosure statement just says what are our accounting principles. In this section, you will see a whole lot of costs listed out, and against every cost, it is going to say whether they're allowable or unallowable. So I have already talked about this. Administrative salaries are normally charged as indirect costs, but they may be acceptable if we have all these 4 conditions approved by the sponsor. And if the sponsor approves, then administrative salaries can be charged. We do have the CTSA NIH grant that covers part of Lynn Copland's salary. So that's an example of how administrative salary can be charged to a grant. So these are the cost principles, again, continuation of all these different costs, and I'm not going to go through them because I need to come to the audit requirements. So the purpose of this section is mainly to indicate how we have to have ourselves audited by a single audit clearinghouse. So, so basically these are the audit requirements. If we are spending more than $750,000 of federal funds, we need to have a single or a program specific audit. Single audit is, when the single audit clearinghouse audit agency comes and looks at all our expenses, federal expenses for a fiscal year, and they follow very standard compliance requirements. So for UVA, the Department of Auditors, State Department of Auditors are doing this single audit for us and all other Virginia agencies that are spending more than $750,000 federal dollars. So program specific audits, when they just have a couple of programs funded by federal agency. We fall under this single audit requirement. Now, these are all, what the audit requirements are for subrecipients and contractors, and for for-profit subrecipients. These sections are also very good for us to read. Now, under the single audit, every year the government will come out and issue a compliance supplement to the UG. So the compliance supplement will actually tell the auditors what to audit us for. And the most current compliance supplement has been released recently in August. Now, these are some categories that the auditors look at. And then we also have program-specific audits by federal agencies or pass-through entities. They come and look at our expenses, and we are continuously going through different audits and reviews all the times. Then we have, Department of Energy Lab coming in. Or these days, even the foundations are auditing us. Gates Foundation, may want to audit us. And then we also have, another area where Office of Inspector Generals from different federal agencies, they come and audit us and they investigate us. So once an audit is started, our record retention goes totally out of the door. We have to maintain all the records of the federal programs till the audit is resolved. So who can give me this answer? Federal law generally requires grant financial records to be kept for a minimum of 3 years. Good. So I'm going real quick because I want to give you all some time to ask questions. So according to the Uniform Guidance, costs incurred prior to the project start date are allowable only if approved by the sponsoring agencies. So what is the end date of a federal fiscal year? I think we all know that. It's September 30th. So now I'm going to open it up for a few questions. I have about 4 minutes left. So you are most welcome to ask me the questions directly or through the chat. Ian, yeah. Hi, Ian. Are you trying to ask me a question?
Mila, I have a question. So you mentioned kind of two facts, and I'm trying to clarify. You mentioned that after 90 days, we need to submit a final report, but then you said at 120, which is an answer is correct. So, or like, for example, for exam, what it will be a correct answer?
So for exam, you would use, when is your exam? Depends on that.
I believe in November or in next year. November.
Okay, so the new UG will go into effect, I think, as of November 12th.
So do you think they will be able to change answers?
Right, absolutely. But, you know, although UG says 90 days, NIH, NSF, they have gone back to OMB and got their approval to use 120 days after the end of a period of performance. You know, they need to get their final numbers and technical reports. So now UG is saying, hey, so if you want, I can send you all the redlined version of the UG.
Yeah, it would be nice.
And yeah, that way you get to see, you know, what is being changed and how it's going to impact us.
And same question.
Okay, so I'm going to do that.
So it's pretty much same question.
Yes, what other question?
Micro purchases, it's when you said 3,000 and then new is 10,000, which is correct.
10,000. 10,000 is the correct. So correct amount. And you will see that the updated UG, there are certain sections that has already gone into implementation. So this is the micro purchase threshold increase has already been implemented since August, if I'm not mistaken. Because there was always a difference between the FAR clause, the National Defense Act, NDAA Act, issued in 2017 and 2018, and the UG about the micro purchase threshold. UG always showed it at 3,000, where, you know, the FAR clause and the NDAAs, subsequent NDAAs, increased the amount to 10,000. So now with these two National Defense Acts and the FAR clause, and micro purchase threshold is going to be 10,000. So again, you will see it in that red line version of the UG.
Okay, so I have another question, but maybe someone would like to ask you too. So since no one asking, what about FNA? And when we are calculating FNA, we are just using federal awards or we using all awards?
Oh, so you're talking about the research base? It's
Yes.
all awards.
But why we are using 25, only like first 25 when we are calculating FNA for example, Gates Foundation, because Gates is not using NTDC. So they put 10% on top of it.
Yeah. So the non-federal sponsors, they follow their own. We know that our FNA cost is at, our federal rate, but we are subsidizing our FNA costs for the non-federal sponsors. So this has been noticed by all the schools, but unfortunately the foundations really do not have enough funding to cover the full costs of research. So they pay us the FNA costs, operational costs, at a lower rate.
I'm not agree with this because, for example, Gates Foundation giving 10 million award and 5 millions will be subcontractors, for example. So it will give like 10% of FNAs for the total award, which will be pretty much 61.5. But so your answer is we are calculating total research award from foundation, from federal, from military or DoD. Is this correct?
So I didn't get you. I'm not wrong. So when we are accepting a 10% of FNA on total direct costs from the Gates Foundation, we are subsidizing our federally negotiated recovery rate. So what we should have recovered, we are not recovering. But I think you are trying to say is, since this is a difference between total direct cost versus modified total direct cost, if Gates Foundation is if we are issuing a sub-award under Gates Foundation, then we get to keep 10% of that sub-award, right?
Correct.
Yeah.
And like I said, sometimes those sub-awards
but generally, you're breaking up, Siri. So, hi, Siri, you're breaking up. We can take it offline, Siri. If you have more questions, I'll be more than happy to answer you. And, probably direct you to some publications that you can read about this.
Sure.
So, and if we don't have any other questions, I think we have already gone 4 minutes over the slotted time. But again, you can reach out to me, whenever you need to, and I will give you more information. I love to.
Okay, everyone. I don't know if it's on my end, but it's definitely freezing up. So thank you, Irmela, for the presentation. I will send these slides out later this afternoon. And if any questions come in, feel free to email myself or Irmela, either one, and we'll go from there. So I hope you have a good rest of the week, everyone.
Rita, before you send out the information, I will also send you a document, the red line version of the UG, that you can share with the group.
Okay, that sounds great. Thank you.
Okay. Thank you. Thank you, everybody.
Bye.
Bye.